Good morning and welcome back to the Opportunistic Trader for Wednesday, the 16th of January, a little bit cold day down in Florida. It's about 58 degrees and sunny, but for us a little bit chilly. Overall, the trades have been chilly. We got stopped out of our short S&P that we sat in for 4 days. Probably should have covered it when we covered the NASDAQ, but thought that the market would trend lower, but somehow bad earnings have taken stocks up and good earnings have taken stocks up. So today, it's interesting. Today, they actually had better earnings than expected, and the market is languishing. I mean, it's up, but it's not really up much. And you have Goldman Sachs up 6%, Bank of America up 5% off of earnings, and overall, same mantra. Some of the tech names look a little bit weak today. Facebook, after having a $25 run up, has come in 40 cents, and Netflix the same, $100 run up, $110 run up. It's come in at $1. So we're sitting here. There's not a lot going on, as we said before. Volatility is contracting every single day. It is down again today at 18, down another 4%. It's more than in half of where it was before. We're back in the range of before we even had the down move. So they're pricing in, I guess, that we're going to continue to go higher here. I don't really see it, but that's the case overall. I know Mike was waiting yesterday for the Brit exit vote, which was not market impactful. I think it actually kind of went the other way. The British pound rallied off it, if I'm not mistaken, up to 128.5 when everybody thought it would go the other way. So, that's part of the algo trade. The algo just knows positions and snoops out the positions and just jams the other way. So, on currencies, there's not a lot. The euro against the dollar is about 114, a little lower. Nat gas still going up, but stopped the explosion of 16% in a day. Bonds are slightly lower, but still hanging around the 145 area. On oil, down slightly today. Probably the reason why the S&P is not up more. And gold stuck, not moving. There's not a lot of movement. In about less than half a month, they took the entire volatility away from the market that existed in 3 months of trading. And now big moves in the S&P will be $20. So that's sort of where we sit today. Joined by Vince and Mike as always, and I'm interested in hearing their thoughts on the market.
Okay, Mike.
My thoughts, I kind of recapped before everybody came on. The yields are a bit higher, but other than that, as Larry was saying, vol is lower across the board. Very sleepy markets right now. Yesterday, the Brexit vote did come at 3 o'clock, and initially, the pound sold off. We were trading about 127, traded down to 126.50, and then rocketed higher. The idea is now there's going to be a no confidence vote, and then the idea really of why it kind of went higher is that they're expecting something to come, but it's going to be a lighter version of the Brexit, which is more market friendly, I guess. But we'll wait to see what continues to creep out, because it's been going on for years and years and still no resolution there.
What are they afraid of? I'm just curious. What are they afraid of to exit?
Disrupting their business.
Well, it's definitely going to disrupt the business, but in the end, it's like anything. It's like going to the doctor and getting the shot. You're freaking out, but the shot will probably make you better.
I think there's domestic concerns about carve outs for trade deals. For example, and I'm making this up in terms of which country, but the concepts of Ireland wants to make sure that they have their trade deals. It's kind of like corporate carve outs, but along other nations that are within the UK. Ireland wants to make sure that their trade deals are okay with Europe. There's visas.
It's imagine if California all of a sudden said, "Hey, we're going to be a separate country." there's a lot of things that, whether it be government tied into paying, employees. I mean, there's tons of different trade negotiations between cross state lines. It's not an easy thing. And, they voted, with the idea of jumping out, but there's a lot of fine tuning that needs to go along with it. And just like we see with any political sort of event, there's tons of people who strongly believe one way versus another. So it's never easy.
Yeah. An ironic thing, Larry, and as a trader, I think you'd appreciate this. If just at the very simplest level, the financial institutions would have better tax ramifications or trade ramifications to say relocate to Paris or Brussels or Germany or what have you. That's a simple thing to look at that we all know about. But the funny thing is, and I think as a trader, I think we all appreciate this, is that Europe is going to add or Europe has proposed adding a tax of a penny or 2 cents to every transaction that goes through their exchanges because they know that they're probably going to be in a position of strength now, which is just basically, an arbitrage now between do you move and pass off your costs to your clients, you get what I'm talking about. It's basically about money and people carving out trade deals.
But the markets are a bit quiet. Other than that was the story for yesterday. But looking at the year so far, Nasdaq's up over 5%. Russell's up, I believe, about 7%. S&P's up about 4%. Yields, the 10-year I'm looking at is 274. The 30-year is 310. 2 years 255.
Year's over. Year's over. They got it.
16.
But looking
Goldman's
forward,
came out
or
with earnings, and Goldman's trading up about 3%. We're trading at 185. I don't know the chart, but I think 65.
We traded 151.
151 in gold. Yes.
Yeah. And the funny thing is these stocks could take out the lows at some point, but the bottom line is it's not at this point, not now. And, the VIX it just popped below 17, but it's back above 18. And there's nothing really to do. No, the trading has sort of been taken away, all in about 2 weeks. So you got to just be patient and wait it out. So that's our advice here. Of what you should look at from the outside. It's rather slow.
Vince, what are you looking at?
just to recap last night's events and maybe put a little expected value on them. Last night, China, just working around the world in terms of what did happen and did not have much of an impact on any markets, as Larry said. China injected about 560 billion yuan into the system. I think that's a record for them. But rather than make too big a deal about that, I think people should focus on, if they are, and I think markets are properly handicapping the fact that the yuan are being injected separately from the stimulus package. It really doesn't have anything to in depth to do with the trade war. They're getting set up for a holiday, and I think they're clearing their plate monetary policy wise before their Lunar New Year. Japan reported machine orders below expectations, and I think the yen's recent strength will probably give the Bank of Japan reason to lower inflation expectations when the Bank of Japan does meet next week. The May confidence vote. You could, if May, I think the market's largely discounting that she's going to retain her position. And I think a big part of that is because they may not like her or they may not like the deal she carved out, but there really isn't much of any person stepping up to show an alternative. So assume you can handicap that odds are she's going to retain on a confidence vote, although I would never discount, the volatility of political people. And if she does retain confidence vote, that would be well, put it this way: if she loses the confidence vote, don't be surprised if cable weakens. Either way, I think the Brexit bucket will be kicked past the March deadline for the right reasons, possibly this time, of actually getting a deal done. But that's basically it. That and and the trade wars will continue to go on. Some federal workers were actually brought back to work without pay. They must be essential to how the government's run. I don't know who they were or what areas they were, but the trade war, we were talking about how it shaves about 0.1% off of GDP per week. I think if people were to look at that phrase and look at it properly, it takes 0.1% weekly off of annualized GDP. So we probably lost about 0.4%, assuming that the administration's numbers are anywhere near accurate. Other than that, if we're talking about things like this, then that's because there's not a lot of trading opportunities. And I would like to acknowledge that despite my own admonitions for over trading in a flat market, I did a trade yesterday that lost me money because even though it was good risk reward, I let it run at a wider level than I should have. The point is, if fund managers are sitting on their hands because they're not worried about there's a hangover from the last 2 months of last month of trading, then active traders should be a little more picky, and that's a lesson that I have to learn every time the market flatlines.
Yeah, that's a good point. So it looks like there's a lot of earnings coming out. You guys, yesterday, you and Tom did a really good options seminar. We're going to replay that today. Now we're starting the earnings. We're starting to see some of the financials. JP Morgan, Citi, Goldman have all come out. It's interesting to see the reaction. Citi was a bit of a disappointment. It started lower, traded higher. JP Morgan yesterday started lower, traded higher. So let's keep a close eye on that. Some of the tech names are going to start to come out. I know we got Netflix, which has been a big source. Just like last year, Netflix got out of the gate last year, was up like 30% quick. Right now, we're up 32% year to date on Netflix.
It's the same year over year. They get these stocks up humongous, and then they just hold in or fail at the end of the year, like they did last year. And it's interesting. I mean, if you look at Citibank, the stock is trading at $62. You know what the low was?
Pull it up right
now.
It was 48. 48 a week and a half ago or 2 weeks ago. 48. So, these moves are epic. So if you didn't buy them then, you missed it. They were a great buy. My thought was that we were going to stay down there for a while for the first time, ever since there was, back in the prehistoric days when there was trading, not now where there's, algo, buying. I thought we would stay down there for a while. It didn't even last 2 weeks. So the lows were made 2 weeks ago, and the lows are so much lower than where we are now that it's unbelievable. You got stocks up 40, 30, 50. So the opportunity has been taken out. You got to sit back and wait it out here and see what goes on. But I thought it would not be the year of the FAANG. I still believe that, but it's hard to believe when these stocks come out of the gate up anywhere from 10 to 30%. So.
But remember last year, 2017, very low vol year, just grinded straight up. In January continued that. We had a very big January last year. And last eight, maybe it was February volatility started. See something like that where seeing last year higher and then all of a sudden back up. Maybe it's something that shut down or China or maybe.
I mean, anything's possible, but usually the market doesn't do the same thing, like that twice. On the upside, it does it, 50 times, but on the downside, it usually doesn't do the same thing twice. So I'm not expecting that. I'm not expecting, anything big here. I saw some comments that the China talks actually aren't going well, but I guess that was the thing to get us up at the beginning of January with the trade talks going well. But I heard that they actually are not proceeding too well. And as you know, Trump probably needs a deflector to deflect. So that's a perfect instrument for him to deflect.
Vince, here's a kind of a question for you, or for both of you, for Larry and Vince. I'm just taking an example. Let's take a UPS or a 3M or a Caterpillar. when their CEO gets up for their conference call, I just don't see how they can be too optimistic given the lack of uncertainty, or the lack of certainty, I should say, of the what's happening with global trade, what's happening with, even within the US. How can they really forecast and be confident about where they're headed going forward?
Um, I'll try that first, Larry. That's one to throw me into the breach on. Um, you know, I think I don't have an answer to that. That I think is cut and dry. I think that's actually a very hard question and is more tactical than strategic. How they handle it, I think, is by speaking in platitudes, by saying we're optimistic, but when the short term is bad, I think if you're a manager looking at a business and you have to come out and speak, these guys are going to use rhetorical and uh, 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 devices to calm nerves. I mean, that's their job, to talk people off of ledges if they're concerned. And so, using J.P. Morgan as an example, although that wasn't in your list, I only bring them up because Jamie Dimon actually had to do a conference call yesterday,
Right.
and some comments that came out of that where I could tell were kind of uh, 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 plain vanilla, And I think like any executive or president giving news uh, uh, report or answering questions, they limit and try and deflect things that get a little bit too close to home on risk, and we've seen that. I really don't have anything in depth to add except that it's a case by case basis. While we do recognize, I think the good thing for a CEO to do is to come out there and say we are fully aware and recognize all the risks out there, and we're on top of it. That's one tack. The other tack would be, uh, uh, despite these problems, we think X. So these are all rhetorical devices. I don't really have anything substantive to add to that, unfortunately. Sorry, Mike.
No, that's fine. I'm just looking at some of these stocks as well. They've had a bit of a rebound. It'll be interesting to see how they report. Remember, FedEx, it was in December when FedEx came out and was very cautious. And that was one of the starts that really had the market concerned, because obviously they're definitely seen as a global barometer of growth. And they
Well, why
were
don't we
very
steer
concerned
it back
about
to
Europe.
Netflix, Mike? Because you brought this up yesterday on the option show. Netflix has earnings coming out on Thursday, and Monday, Tuesday, they announced a price hike. And you made the comment on air with Tom and myself. Why not release that during
Well, that
the
wasn't
news?
anything skeptical. That was actually a legitimate question. I'm just not sure because typically Netflix is a different beast. I mean, they're reaching the world. There is a lot of competition. I remember specifically.
No disagreement. What I am steering it towards is not so much the legitimacy of the question, which it remains legitimate. I would not be surprised if someone did not ask that if they do a presser
Right.
after earnings. But what I wanted to steer that towards was, think about how the Netflix CEO is going to have to field a question like that, and what his response is going to be.
Yeah. Larry, I don't think you
I mean,
heard it. What we were talking about it, and I brought it up. We were talking about Netflix strategy. They're coming out with earnings tomorrow. Typically, a release like they did yesterday, raising prices, that's the sort of thing that comes out with earnings, with a conference call, things like
Right.
that. And they said it 2 days early. Like,
Yeah,
kind of,
they
that's a little
probably.
suspicious.
Yeah, well, listen, I'm looking at the straddle on Netflix, and it's not pricing in too much. It's only pricing in for that stock $29. That's
right.
really low, I
Well,
think.
Tom made a comment, and without being paranoid about it, he made a comment. He goes, "Yeah, that's not incredibly unusual. I have seen releases like that before, but it usually is a release that comes out before the release with one goal, with one major goal in mind, and that is to uh, uh, get out any weak shorts and make the news event itself, make the earnings event itself less of a knee-jerk reaction and catch some people by surprise. On the flip side, maybe you release that good news first because your earnings are going to be disappointing. I don't know, but certainly uh, uh,
It's weird
how
that they would do that the day before earnings, but
I know, right?
usually you're in
I
a
mean,
quiet period or something. I mean, I don't know. I don't know the
yeah,
point of
I
that,
don't
but
remember if I spoke about this on air, if I was speaking with Larry off air about it, but I was watching I forget what I was watching, something on TV where they were talking about some technology coming out where they're going to really be able to crack down on sharing of passwords and the possible revenue growth that could be for Netflix. They were talking about how millennials, like I think it was like 50% of millennials are sharing their password. People are sharing with their family, with their friends. One person buys it, and 4 people are using it.
that's completely legitimate because you can
Oh, it'd be
log in.
massive.
Yeah, I mean, they're going to
I
be
think they have
more.
170 million users worldwide that are paying. That means probably they have more like 300 or 400 million using.
That's probably spot on, considering all the people, all the families that, even just look at it at a very simple micro level. A kid moves out of the house. He goes to college.
Sure.
He still has access to the Netflix account. In fact, I log in from different places, and my kids, who live with their mother, they use my account. And I never understood why they let that happen. But
there's only one fee for as many accounts as you can
You
open
can
up.
have like four.
no, I
You can
think
have
it's as
like
many as
four devices or something.
4 devices there. That's it. That's it.
Oh,
And it
really?
doesn't really. The thing it doesn't do, Larry, is compared to say other technology is other technology, newer technology, not much newer, but newer technology, basically puts a cookie on your ISP address. So if you're in Twitter on one account and then you try and log into another account from say ISP address, at least it knows the source. It's all part of tracking cookies. And Netflix started out loose and fast with that, and I guess they haven't updated their tech in that way for years. And maybe it's also part of an electronic incumbency plan. That meaning I'm on it, my kid's on it, he's 22, and all of a sudden I have to pay for him. Maybe I'm going to pay for him
It's
because
like
he's
health
already on it.
insurance at like age 26. You got to be on your own.
Exactly. Right. At age 22, kid, you're cut off from the Netflix because Netflix said so. It's not my fault. I have my scapegoat ready.
Hmm.
But yeah, that's going to be a revenue source, and I think that's something long overdue for them to do. But I guess they were afraid to do it in the beginning because their hold on the market was tenuous. But research that I have read over the last 2 months has said as Larry alluded to yesterday, the space is crowded. There's all these things all over the place, and surprisingly, Netflix is raising rates in a space where there's a lot of free competition. They must have a lot of confidence in electronic incumbency and their
Going
hold.
from $11 a month to 13, a lot of people aren't gonna have a
No,
problem with it.
they're
No,
not.
they're
They're not
not
going to
happy. Like for instance, I'm a Netflix. I get the subscription. I'm not gonna love changing from 11 to 13, but I'm not gonna cancel because of it.
exactly. But in perspective, when you combine, and there's no disagreement there, when you combine 10% increases in things that like that across the board, you're getting inflation. Maybe we're not going to call it inflation, but that's what you're getting. I mean, I'm not complaining. It's certainly still cheaper than the $150. I mean, it's the value proposition. A 10% pay raise, a 10% fee raise will be tolerated by the public because the alternative is a $150 cable
That
bundle.
I actually heard, and I never really watched Jim Cramer, but last night I'm like kind of scrolling around and I saw something like Jim Cramer's bullish Apple and Amazon because of what Netflix just did, and I clicked on it, clickbait, and I clicked it, and he was arguing that Amazon Prime, I think it's $150 or $120. And he's like, they could go to 150, and same thing. I do Amazon Prime. If they go to, I definitely get my money's worth of that. If they go to 150, I'm not leaving. Apple,
Right.
same sort of thing. Like they're charging 99 cents a month for storage. They're charging $2.99 for this.
But Apple's prices are contracting, especially on the phones. I'm getting hit
No,
on.
that's the thing.
Netflix is
They're
definitely
conflicting
hurting
on that, but
Apple's prices.
they're
You're
selling
right.
like, for instance, 99 cents for storage. If they go to $2.99, I'm not moving. They got all my pictures. They've got all this. It's just so easy. I'm not moving. And that's the next thing that's going to be coming, especially from.
So basically, a rise in prices in Netflix is a green light for possibly, I think, Prime to raise prices.
There is a level
But
where
I don't
it'll
think it's
turn
a. I
people
don't think it's a.
off. There is a level it'll turn people off, but they're not there. I mean, a lot of people say the 120 they're paying for Prime, they could pay double, and they're not leaving.
Yeah, but
No doubt.
you're looking at the 1% of the 1%. You're not looking at really where their business lies, which is, as we know, basically in general, being out there to the world, $10 and $5 and $3 that you guys are talking about means a lot to a lot of people, especially
Yep.
if you're going up $25 a month or $30 a month.
Yep.
Those are numbers that people can't afford. So
here's
it'll
some
be
perspective
interesting.
for people that do have tight wallets to deal with. To Larry's point, it wasn't too long ago that you could get, before we were streaming, $4.50 got you 2 DVDs and a streaming video from Netflix. So their revenue margins are going up. There's no based on things like that, and that's a 100% increase in price, more than 100% increase in price over 10 years, with a cost of content, physical infrastructure probably going down because DVDs aren't the thing. But yeah, I mean, these things add up. An increase. The Prime model, I think, is interesting. I think if you're interested in competition in this space, the Prime model is what's called, I don't know what the exact economic term is, but it's a 2-tiered cost model, meaning you pay a fee, kind of like Costco. I don't know if you guys have Costco in Florida, but Costco, you pay an executive fee, or they call it executive, right? Costco, and you pay that, and then you get discounts, and then you maybe get rebates, and that's what the Prime model is. It's kind of like a taxation. You pay to be in the club, right? And then you get a lot of free videos, and then eventually you'll start clicking on the ones that take you upstream and make you pay more, which are still $1 cheaper than Apple. So I don't think Apple has pricing parity to raise right now on their iTunes, Mike. But on their storage, I think you're right about that. Prime could raise prices. So I don't know what Kramer's point is, except that Netflix is operating in there's a lot of spread between the cost of Netflix and the cost of Prime for people in the middle and lower middle income classes. So I don't think Netflix hurts himself too much, but I think Prime would, and Prime wouldn't hurt themselves too much either by raising rates, because they're not going after the target audience that Larry's discussing, that Larry's alluding to. But I think Apple, once upon a time, the Goldilocks product, is feeling it, and I have evidence of that in how they're handling some contracts that aren't discussed too much. But I think Apple has to diversify their revenue streams,
Evidence?
because iTunes.
Produce your evidence. What do you got?
Well, I mean, it's just hands-on evidence. It's historically, when a business that has fat profit margins and has room to cut fat doesn't cut fat, that's because they're a growth business. But when a business, and I'll lay this out and then give you the exact example that anyone could go to a store and see what I'm talking about. When a business's profit margins start to get tighter, they start to squeeze suppliers and squeeze licensors. So my example is this: 2 years ago, less than 2 years ago, 1 year ago, you could go to a store and you could pick up an off-brand cable for your Apple iPhone, and it would work. And this is even after they went to the chip, meaning the different port for plugging in. But 6 months ago, I went to the store and to buy a replacement cable, because those cables work, but they're not really that well made. I went to the store and I went to buy the same off-brand cable that wasn't the guy's like, yeah, it works, and I plugged it in and it worked for 2 weeks, and then I downloaded the next iOS update on my phone, and the cable stopped working. And so I looked it up, and the concept is Apple is going out to any manufacturer of cables that are compatible with their product, and they're now saying, if you don't pay us a license fee to give us our pound of flesh for being compatible with our phone, we're going to lock you out technologically. And so Apple is squeezing non-licensed users out. And so I went from paying $5 for a cable, long story short, I went from paying $5 for a cable that I knew would last me 6 months to having to pay $15 for an off-brand cable that was licensed through Apple, as opposed to $16 for the Apple cable. So Apple is squeezing the fat out of its and leveraging its brand to help its top line, because its bottom line is getting squeezed. And that to me that came in actually right before Apple sold off, and I'm like, oh God, if I'd only acted on the fact that my cable doubled in price, I would have recognized that. But there you go. I mean, Apple's not a growth company anymore, at least right now. Apple is a company that's securing its protective moat around its franchise.
Well, back to the markets. Bank of America and Goldman Sachs are the releases of the morning so far. Bank of America is trading up 5.5%. Goldman is trading up 3.5%. So that has the equities firm at the moment. S&P's up 8.5%.
S&P should be actually higher basis this. So it's interesting. May look to try to short it again and hopefully pick a good level. Interesting one. Natural gas just rallied 5% in about 3 seconds.
Wow, yeah.
So I don't know if there's a release out in oil and natural gas, but
the weather
oil,
report probably just came out.
Yeah,
it's cold.
Yeah, I don't know. And then it'll be warm, and then it'll be summer, and then it'll be over. But
well, a lot of it is that the New England infrastructure thing, but that's a question for Bryn Kelly.
Yeah, she'll be on tomorrow at 11. Today's schedule, we have at 10 o'clock, we're going to replay yesterday Tom and Vince's options seminar, which was really insightful and a lot of good information. I know a lot of people miss it in the afternoon. 11 o'clock, Tracy Schuchart's going to be joining us talking technical analysis. She's going to be going over her typical markets, which are dollar, crude, S&P, gold, and then, bless you.
Thank you.
And then also a surprise, she's going to be, I asked her to take a look at Bitcoin chart and just give me what she thinks technically on that one. But she's going to be joining us at 11, 12 o'clock, Joe Vaklovic. And then, actually, that's what we have for today. So that's what we have for today. And then we'll also be on in the afternoon. And, looking at the markets right now, S&P's up 9, like we said, some good earnings as of right now. Some Brexit comments are expected. Data's really delayed heavily. We have not gotten much data because of this government shutdown, and that's one thing we hadn't really touched on. But now government releases and, talking about the Fed and talking about interest rates, things like that. We're skewed now for a good month and a half, 2 months worth of data. We're not going to have real numbers until really March, and who knows when this government shutdown even ends. But whenever releases come out, they're going to say, oh, well, it's skewed by the government shutdown, things like that. Yeah,
well, it probably will still be shut down at that point. I don't see any way out of it. And it's actually, to be honest with you, it's absurd. And it's just ridiculous that they're holding the country. Well, it's interesting, though, really, if you look away, the market has no reaction. Doesn't even matter. If the government stayed shut down for another year, it would have no impact, which is shocking.
Well, that's the question. At some point it will, but we have not seen it yet.
But I don't know what it will. Like, they're just going to reopen whenever they open, in tomorrow or in 3 months, and they're just going to pay everyone back all the money, print more money, and move on. And you know what? It'll actually rally because they'll say it's good that the government reopened. So, it'll act as a positive catalyst, even though it was never really a negative catalyst. But that's the market that we're in. And, we had a little bit of down for a quarter in the last 7 to 10 years, and we're right back up to higher than we were when we really melted down. So see what happens.
I think it was last year we started at 26.75 or so. Last year's sell-off.
I thought we were maybe flat to higher, because I think the S&P is up almost 5% coming into this morning, and last year we were only down 4.6%. So I would check that, but we're right in the unchanged level either way. And, the bottom line is everybody's okay, because really, other than hedge fund or forced selling, no one sold down there. So the public is long and strong. Volatility at $17.95, down from 36.5 2 weeks ago. So that's really the big story, and we'll see how everything goes in general. Today is not a NASDAQ day. Today is an S&P day, with banks outperforming the market to start the day. So we'll be back to you guys after the opening. Mike and Vince, thanks for joining me, and we'll talk after the opening. Good luck, everyone.